what's up? Red Panda Anthem. Red Panda, what's good?
So let's get into this. A record-breaking year for life insurance payouts. $100 billion was paid out in 2021 from life insurance companies to beneficiaries. So that is actually an 11% jump from 2020, which represented the largest year-over-year increase, 15% since 1918 influenza pandemic. So that's crazy. So all right, life insurance.
Yeah.
Whenever I have a financial planning call for EY University, I always get the most questions about life insurance. It's an ongoing thing, like every single time. So it's never a bad time to talk about life insurance because I realize that so many people still have so much questions about life insurance. But I want to talk about it, but I want to get you guys' opinions on it before I start talking about it. So, All right, $100 billion was paid out last year from life insurance companies to beneficiaries. So what's your initial thoughts on that?
I'm a little conflicted, to be honest with you, right? For a couple of reasons. The first reason is that if it's paid out, that means people actually had it. And I'm telling you, when we sat down 15, 20 years ago, and we were talking about life insurance, it was not even a topic in our community. Like nobody was even interested in hearing about it. Yeah. Now, out of that 100 billion, I'd be interested to see how much it was paid out for communities that look like us. That is a statistic I would like to see, but I don't know. Is it encouraging? I'm torn. I'm honestly just torn about it.
But why are you torn?
Well, because we know that's a form of a way to generational wealth, right? Like for our communities, that hasn't been a way, but we know that it is now. And obviously what you're doing and everybody is doing in the financial literacy movement, talking about it and showing how it can be a builder block for generations that are here outside of us. 100 billion is obviously a huge amount. I'm just saying how much of us are represented in those numbers, right? So like, yeah, it's great that people are aware that life insurance can be a building block. Are we aware and are we represented inside that 100 billion?
Well, that's a great question.
We should be.
Yeah, I mean, I'm that's what I'm saying. I'm torn. I'm conflicted on it. I don't know. What's your thoughts?
To be honest, I haven't done enough research on this topic, so I think it would be a disservice to the audience, myself, and this amazing show to give commentary that is not based on fact or research. I know some people think I just rant because, you know, I like attention. This is backed by God and the work that I put in. So I don't, but Troy, your point is really interesting. I wonder how much of those payouts were dispersed to us, especially from the conversation that we had with Don Peoples last night. I would estimate probably less than 15%, but I do want to give a homework assignment for the money that has been dispersed over the last 5 years to the audience, how much of that goes to Black and brown families. And it's not because we're not applying, because I know a lot of people say, well, if people apply to get it, I have personally went through situations when family members have poured into a policy for 20 and 30 years and did not get their projected earnings upon supposed to getting that death benefit. But I think it would be a disservice for me to speak on this one.
You said 15%, you think?
I'm
just saying, like, that's.
Well, all right. So the thing about
that's a high ceiling.
That's a high ceiling.
So there's two different.
Just really quick, because like even when we do have it, I feel like, especially like if people have insurance through life insurance through their job, the amount is like so low, right? Like even when I told people when I was 25, like I have $1 million policy, it was like, how did you do that? Like, why would you do so much? And I'm like, well, it's for the years that when I'm gone. So the mindset wasn't even there. But I mean, this guy's the expert at it.
Come on, Shotty. Come on. Let it go crazy. I feel it.
Well, I feel like, there's two different conversations happening. If we're taking advantage of it or not, that's a conversation that we don't know. We'll have to see the numbers. I would suspect that there has been an uptick, but I would think that we're still underinsured as a community. I would think that we're still underinsured. Now, that's one conversation. The other conversation is, okay, $100 billion is being paid out. We understand that life insurance is one of the fastest and easiest ways to grow generational wealth
Mhm.
because you're pretty much paying for money, pennies on a dollar, right? Like if you have a life insurance policy, it's $1 million policy. Let's say you've paid $100,000 of premiums before you died, then you've
Mhm.
purchased $1 million for 100,000.
Mhm.
That's a good deal in anybody's book, right? So, but it's important to understand the life insurance that you're actually getting and how the process works. So, like even when Ian was saying that, a lot of people they might have paid into a policy for 20 years or 30 years, and then they don't actually get, or the policy, expires or explodes or different things of that nature because not all life insurance is created equal. That's
Yes.
something that's extremely important to understand as well. So when you're buying your life insurance policy, it's important to be educated on what you're purchasing. It's just like anything else. Like if you're purchasing a home or if you're purchasing a car, every car is not the same. Every home is not the same, right? You have to be educated on what you're actually purchasing so you can have the most efficient outcome when it comes to that. So briefly, because I've talked about this a few times, but term insurance, very important to understand. That is the lowest costing insurance, lowest premium. It lasts a term, 10, 15, 20-year term where you pay a premium. You have a death benefit. Let's say you have a 20-year term policy, right? You pay a premium for 20 years. And if you pass away before that 20 years is over, then your beneficiaries get money. Now, the problem with term insurance is that I think like 97% of term insurance policies don't actually end up getting paid out because most people don't die within the term.
Mhm.
So to get insurance, you have to be approved for insurance, right? And there's underwriters. So they're usually not going to approve somebody that has a high probability of dying within a 20-year term. So anybody can die at any point in time, but you go by odds, right? And it's mathematical
Mhm.
statistics. So it's like the odds of somebody that's 25 and they're healthy dying in a 20-year next 20 years is relatively low. So now you can afford as an insurance company to give, insurance to a lot of different people because only a few people is actually going to die. And the few people that do die, the other, 97% of people that don't die, those premiums are going to make up for that. But it's still beneficial because some insurance is better than no insurance. And if you don't have a budget for anything else, then term insurance can be a good option. And then you have whole life insurance, which lasts your whole life. And it also builds cash value. The cash is money that you can actually use while you're alive. Now, a lot of people have criticized whole life because they say that it's too expensive and they don't want to mix investing with permanent insurance. It's your own personal prerogative on that. There's pros and cons for it, but the general idea of it is that it lasts your whole life. But there is a hybrid approach, guaranteed protection, universal life. We've talked about this at EY University a lot, where this is a pretty much like a lifelong term policy. So you're paying premiums, and as long as you pay a premium, you have a death benefit. So that's extremely beneficial because now if you don't want to mix investing with insurance and you just want the clean cut, just whatever I pay for, I'm going to get, if I die, my family gets money, then that's an option. And the premiums are less than whole life insurance, but they're more than term. So you kind of get in the middle ground for that. Now, where people come into problems with their policy a lot of times where they don't fully understand it is universal life policy, index universal life policy, and variable universal life policy. This is life insurance that's tied to the stock market. Now, this is where it kind of becomes a little tricky because there's a lot of variables that go into play. So this is a hybrid type of insurance policy where you're actually mixing insurance with investing. The problem with this is that if you don't fully understand it, and in times like even now when the stock market is down, now that can draw on your cash value and negatively affect your insurance policy. So this is something that you have to be extremely educated on. If you're going to mix the life insurance with investing, you have to know how much money you're putting in. You really want to overfund the policy in that scenario to make up for any down years in the stock market. And you have to be careful when you take money out. So like I said, I can go on for this for a long time, but I just wanted to
two cool questions for you. I'm going to cut you off. I want you to finish, but before we go to the next one, I do have two cool questions for you that I think help the audience.
You good? Go ahead.
If you, let's say a person is making $100,000 a year, what is the multiple that they should have for the death benefit when they pass?
So yeah, good question. And of course it goes by like if you have a family or a house, but rule of thumb is that you should always have probably 10 times your income. So if you're making $100,000 a year, you should have at least a minimum of $1 million life insurance policy. Mm-hmm. You might need more. Like I said, if you have kids, if you have a mortgage, you might even need 2 million or 2.5 million. But at the very least, you need 10 times your income. That's like, rule of thumb. And that might seem like a lot, but it's really not. So if you think about it from a standpoint of, all right, let's take $1 million policy, right? And let's say you're even making $50,000 a year. So we'll do 20 times your income from this area. Let's say you're making $50,000 a year, right? Now you have $1 million policy. So what happens is that when you die, your beneficiaries have an option usually, and this is why it's important to educate your beneficiaries as well. But your beneficiaries usually have an option where they can take a lump sum, or they can take it's kind of like a checkbook where the insurance company will send them a checkbook and then they can just draw off of the insurance policy whenever they need the money. But let's say that they actually just take the lump sum of $1 million. The $1 million is going to be a tax-free million that's going to be to your family 9 times out of 10. So you get $1 million. So now the worst thing that you can do is just give somebody $1 million with no plan, because we know that they're going to blow that $1 million very, very easily, right? So now, and this is what Storm Lee was talking about, if you set the $1 million up, well, you can set it up in a trust, or even if you don't set it up in a trust, you could just give them directions on how to actually invest it. And let's say that they just invest the money in long-term conservative index fund, right? And they're drawing, let's say they draw 5% off of that. Why do I say 5%? Because the Monte Carlo stimulation factor is that if you draw 5% over the course of time, then you'll never run out of money. That's like a retirement formula. So if you take 5% from $1 million, that is $50,000, right? So that's really replacing your income in that scenario. So when you look at it from that standpoint, if you look at, okay, even if you go higher, you'll say even if you take 7% off of every single year, every year you're taking 7% off, and that's higher for people that's taking money from their accounts. Now you have $70,000 a year. It doesn't seem like that much money, right? You're just replacing your income pretty much. So it's not like so if you're making $100,000 a year, you're probably walking away with $65,000. So if you have $1 million life insurance policy and you're drawing 7%, 70,000, you're pretty much just replacing your income at that point in time. So this is why it's beneficial to have more than, and you got to realize too, if you're making $100,000 and you have a $100,000 policy, I mean, that's just 1 year. Like you might live for what your family's going to need money for 20 years. Your family's going to need money for 30, 15 years. So it's important to think bigger. So that was kind of a long answer to the question, but I just wanted to rationalize it, because I know if I just say like you need $1 million worth of insurance, people are like, I don't need $1 million. Like I don't even have $1 million. Why would I need $1 million? Well, A, that's not the best way to think about it, because you want to leave more money than you have. But also just from a pure practical standpoint of replacing your income, because that's what life insurance is for, you're going to need a bigger number to replace what you're currently living on.
This that Red Panda Anthem. Ian, what's up? This that Red Panda Anthem. Red Panda, what's good? Red Panda Anthem. Whole clip going up. I know they can't stand it.